Preparing for a commercial credit analyst interview questions interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a commercial credit analyst do? A commercial credit analyst assesses whether a business borrower can repay debt under the proposed structure. I review financial statements, cash flow, leverage, collateral, industry risk, management quality, and repayment sources. My job is not just to say yes or no. It is to identify key risks, recommend mitigants, and support a clear credit decision that fits the bank's risk appetite. That discipline protects depositors and relationship profitability. While answering, focus on credit risk assessment, repayment capacity, financial statement analysis, collateral review, industry risk, and how the analyst supports lending decisions rather than simply approving or rejecting loans. Question 2. How would you evaluate the creditworthiness of a business borrower? I start with repayment capacity because cash flow is usually the primary source of repayment. I analyze revenue trends, margins, EBITDA, free cash flow, leverage, DSCR, liquidity, and working capital needs. Then I assess qualitative factors like management experience, customer concentration, cyclicality, and competitive position. Finally, I compare the request to the loan purpose, collateral support, covenants, and downside case to decide whether the risk is acceptable. Make sure to cover both quantitative and qualitative analysis, historical performance, projected cash flow, leverage, liquidity, collateral, management credibility, industry conditions, repayment sources, and fit with loan purpose. Question 3. Walk me through the 5 C's of credit and why they matter. The 5 C's are a practical framework for organizing credit risk. Character looks at borrower integrity and willingness to repay. Capacity measures whether cash flow can support debt service. Capital shows how much equity or cushion the borrower has. Collateral provides secondary repayment support if cash flow fails. Conditions cover the industry, economy, and loan purpose. I use the framework to connect financial analysis with structure, pricing, covenants, and monitoring. In your answer, talk about character, capacity, capital, collateral, and conditions, but avoid just listing them. Explain how each factor helps identify repayment risk and loan structure requirements. Question 4. What is the difference between cash flow lending and asset-based lending? Cash flow lending relies mainly on the borrower's operating cash flow to repay debt. So I focus on EBITDA, free cash flow, leverage, and DSCR. Asset-based lending relies more heavily on collateral, typically receivables, inventory, or equipment, with availability tied to a borrowing base. For example, a distributor with volatile margins but strong receivables may fit an ABL structure better. The key difference is whether repayment confidence comes primarily from earnings or liquid collateral. Be sure to mention primary repayment source, underwriting focus, collateral dependence, borrowing base mechanics, borrower profile, monitoring intensity, and why weaker or cyclical borrowers may need asset-based structures. Question 5. How do you spread and analyze a company's financial statements? When I spread statements, I put financials into a consistent format so performance is comparable across periods and borrowers. I review the income statement, balance sheet, and cash flow statement, then calculate margins, leverage, liquidity, turnover, and coverage ratios. I also adjust for non-recurring income, owner compensation, one-time expenses, or unusual working capital movements. The point is not just clean numbers, it is understanding trends, repayment capacity, and where credit risk is changing. While answering, focus on standardizing statements, calculating trends and ratios, adjusting for non-recurring items, reconciling cash flow, and using the spread to support credit judgment rather than mechanical data entry. Question 6. Which financial ratios are most important in commercial credit analysis? The most important ratios depend on the borrower, but I usually focus on leverage, DSCR, or fixed charge coverage, current ratio, quick ratio, gross margin, EBITDA margin, and working capital turnover. Leverage tells me how much debt the company carries. Coverage tells me whether cash flow can service it. Liquidity shows near-term flexibility. I never view ratios in isolation. I compare them to history, peers, industry norms, and the proposed repayment schedule. Make sure to cover leverage, coverage, liquidity, profitability, and efficiency ratios. Explain that ratio interpretation depends on industry, borrower size, trend direction, loan structure, and peer comparison. Question 7. How do you calculate and interpret debt service coverage ratio? DSCR measures how comfortably a borrower can cover required principal and interest payments. A simple formula is cash flow available for debt service divided by scheduled debt service. For example, if adjusted cash flow is $1.5 million and annual debt service is $1.0 million, DSCR is 1.5x. That means there's a 50% cushion before coverage breaks even. I also test downside cases because a strong current DSCR can weaken quickly if margins compress. In your answer, define DSCR, explain numerator and denominator, mention common adjustments to cash flow, interpret thresholds like 1.20 times, and discuss why trends and sensitivity matter. Question 8. How would you analyze a borrower's working capital cycle? I look at how quickly the business turns sales into cash. That means analyzing days sales outstanding, inventory days, payable days, and the overall cash conversion cycle. If receivables stretch from 45 to 75 days, the borrower may need more revolver availability even if profits look stable. I also check seasonality and customer payment behavior. A growing company can still face credit stress if working capital absorbs cash faster than earnings generate it. Be sure to mention accounts receivable days, inventory days, accounts payable days, cash conversion cycle, seasonal needs, revolver usage, and how working capital pressure can create liquidity risk. Question 9. What red flags would you look for in a commercial loan request? I watch for declining revenue, margin compression, negative operating cash flow, rising leverage, slower collections, stretched payables, and repeated reliance on short-term debt. Qualitative red flags include customer concentration, weak internal controls, management turnover, litigation, tax arrears, or vague use of proceeds. Another concern is projections that assume a sharp turnaround without evidence. Red flags do not automatically kill a deal, but they require stronger structure, collateral, covenants, or a clear mitigation plan. While answering, focus on deteriorating cash flow, rising leverage, liquidity strain, customer concentration, aggressive projections, frequent overdrafts, tax liens, covenant breaches, management turnover, and unsupported loan purpose. Question 10. What covenants would you recommend for a commercial borrower, and why? Covenants should match the key risks in the deal. For a cash flow loan, I may recommend minimum DSCR, maximum leverage, and required financial reporting. For a revolver, I might add borrowing base reporting, liquidity thresholds, or limits on additional debt. Negative covenants can restrict dividends, asset sales, or major acquisitions. Good covenants are early warning tools, not traps. They give the lender time to act before repayment capacity deteriorates materially. Make sure to explain affirmative, negative, and financial covenants. Link covenant selection to borrower risk, early warning value, lender protection, flexibility, and avoiding overly restrictive terms that harm operations. Question 11. How do you evaluate collateral for a commercial loan? I evaluate collateral by asking what it is worth, how quickly it can be converted to cash, and whether the bank has a perfected first lien. Receivables may receive higher advance rates if they are current and diversified. Inventory may be discounted more because liquidation value can be uncertain. Real estate needs appraisal and environmental review. Collateral is important, but I treat it as a secondary repayment source. Strong collateral cannot fix weak cash flow. In your answer, talk about collateral type, marketability, advance rates, appraisals, lien position, liquidation value, concentration, documentation, and why collateral is secondary to repayment capacity. Question 12. How do industry conditions affect your credit analysis? Industry context helps me judge whether the borrower's performance is sustainable. A 10% EBITDA margin may be strong in one sector and weak in another. I look at cyclicality, pricing power, regulation, labor costs, commodity exposure, and customer demand. For example, a construction contractor may need more conservative leverage and stronger liquidity because cash flow is project-based and cyclical. Industry risk influences repayment assumptions, covenant levels, collateral requirements, and monitoring frequency. Be sure to mention cyclicality, regulation, commodity exposure, competitive pressure, supplier and customer concentration, interest rates, macroeconomic sensitivity, and how industry risk changes structure, pricing, and monitoring. Question 13. What should be included in a strong commercial credit memo? A strong credit memo should make the decision easy for the approval officer. I would include the borrower background, ownership, loan request, purpose, repayment source, financial analysis, projections, collateral, guarantees, industry overview, covenant package, and risk rating rationale. Most importantly, I would clearly state key risks and mitigants. The memo should not just describe the business. It should support a recommendation with evidence, downside thinking, and a structure that matches the risk. While answering, focus on executive summary, borrower overview, loan purpose, financial analysis, repayment sources, collateral, guarantors, industry risk, covenant package, key risks, mitigants, and recommendation. Question 14. A borrower has declining revenue but asks for a larger line of credit. How would you approach the request? I would first determine why revenue is declining and whether the line increase supports working capital or covers losses. I would review receivables aging, inventory levels, backlog, customer concentration, profitability, cash burn, and updated projections. If collateral quality supports the request, I might consider a borrowing-based structure with tighter reporting. If the increase is simply funding operating losses, I would be much more cautious and may recommend a smaller facility, additional equity, or denial. Make sure to cover root cause analysis, borrowing need, cash flow trends, receivables quality, inventory build, updated projections, availability, covenants, collateral support, and whether the request masks operating losses. Question 15. How would you identify and manage an early warning credit deterioration situation? Early warning signs often show up before a missed payment. I monitor covenant pressure, declining DSCR, higher revolver utilization, overdrafts, aging receivables, inventory buildup, delayed financial reporting, and management changes. If I see deterioration, I would speak with the borrower, request updated financials and forecasts, reassess the risk rating, and recommend an action plan. That may include tighter reporting, reduced exposure, additional collateral, covenant reset, or transfer to special assets if risk escalates. In your answer, talk about monitoring trends, covenant compliance, payment behavior, borrowing base issues, communication with the borrower, risk rating changes, action plans, and escalation before default occurs. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.